speaking of terminology, we're getting a lot of questions here tonight about bid-ask spread. The bid-ask spread is something we heard a lot about ahead of this evening's event.
Yes.
So we asked Jessica, a senior trader in Vanguard's Investing Trading Services group, to talk to us about bid-ask spread. Jessica?
Thanks, Amy. I'm happy to. The bid is simply the highest price that buyers are willing to pay for shares of that ETF at a given time. The ask, on the other hand, which is sometimes called the offer, is then the lowest price that sellers are willing to sell those same shares at. The spread is simply the difference between those two numbers. So if you have an ETF that is bidding $110.50 and asking $110.55, then the spread would simply be 5 cents.
Thank you, Jessica. Now, why is that important?
Yeah, the spread is important to know because it can give you an indication of what your total trade costs are going to be. Additionally, it can give you an insight into how liquid or illiquid an ETF is, meaning how easy it is to buy or sell that ETF. So an ETF with a narrower spread or a smaller spread, like a penny, for example, would be a pretty liquid ETF and probably easy to buy and sell. But an ETF with a wider spread, 5 cents, 10 cents, that gives you an indication that it's a bit illiquid and maybe could be more difficult to buy and sell.
All right, Jessica, thank you. Brian, let's pick up where Jessica left off. Let's talk about liquidity.
So liquidity, it's important to understand how the pricing is determined first and foremost. So to say something's liquid or illiquid, it might be liquid or less liquid, but if you have an ETF as an example that's made up of large cap securities that trade very actively throughout the day and have, as Jessica described the spread, the bid-ask spread, a narrow bid-ask spread, that's how the price of the ETF is derived. So generally you'll see a correlation where the portfolio, if it trades with a narrow spread, the ETF will trade with a narrow spread. If there's a lot of shares available in the underlying securities making up that fund, then the ETF may have more available in the market. So a contra example would be if you have a high yield corporate bond fund, generally spreads on high yield corporate bonds are a little bit wider, a little bit harder to invest in some of those securities, and therefore you would find a high yield corporate bond fund ETF may have a wider spread than, say, a large cap equity security.
But compared to another high yield corporate bond fund ETF, the spreads might be comparable.
They might be comparable, and I think, I know Rich and I have talked about this before. All things being equal, if you had two high yield corporate bond ETFs, that's where you would want to say, if one had a narrower spread, my implementation costs are lower, and therefore I may lean towards that issuer's ETF versus another issuer's ETF.
And information about the bid-ask spread is available when you're looking at information about ETFs.
Absolutely. All the financial service firms or what have you, when you're looking to invest, you can get that information.
Now, we talked about liquidity. Jessica mentioned it, you mentioned it. Let's pause for a minute and define what liquidity means for our audience.
Liquidity is, Jessica talked about how the bid is somebody willing to buy and the offer or ask is someone willing to sell. And I would just think of it as someone's willing to buy or sell a certain number of shares. That's how many shares they have available. There's other market participants that may be willing to take risk. So there's a certain amount of shares that they're willing to buy or sell at the price that's indicated. Liquidity would be the number of shares that are available. And when you invest, you would want to make sure that the number of shares you're trying to purchase are available at that price. And that's also, you asked about, can customers find that information? You will see that information represented.
Anything to add?
I think Brian covered it there. I think liquidity is a common piece of conversation that we have with investors. Where it's perhaps most important is for institutional investors who are transacting in very large blocks who may want to trade at levels that are greater than the liquidity that's available on the website or on some other type of application. In general, for the investors who we're talking to here today, I'd say what they would find is that there would generally be, for kind of broad-based portfolios, ample liquidity for the levels they want to transact.
Easily accessible, popular ETFs wouldn't be faced with the same liquidity concerns than smaller, more, say, thinly traded. Is that a reasonable?
Yeah, I think it's right. Brian talked about this before. A broad index fund that covers U.S. stocks or international stocks or a large segment of those universes is going to probably have a high level of liquidity. As you get narrower and narrower, that's when you may see less liquidity and therefore It's just a really important data point to have at your fingertips.